Great. Good afternoon, everybody. My name is Erez Bahar, and on behalf of Davidson & Company, we'd like to welcome you to our annual IFRS and auditing and regulatory update. We've got lots to cover. Hope everybody had a great Halloween and filled your belly with candies or beer or whatever you do on Halloween on that day. And we've got a full lineup of speakers today to go through various topics. Before that, a couple very important announcements. The most important one is that our firm is hosting our annual Client Appreciation Party on November 29th, and that's going to be 4 to 8 p.m. at our office. We're going to send out the invite over the next couple of weeks, and if you don't get it, you need to contact us, and at the very, very end of the presentation, Bahar will reiterate that and let you know where to contact if you don't get that, and then hope to come. We are doing this seminar not live this time. We found that most people still prefer to do our PD seminars online, and so in lieu of that, we really want you to come on November 29th because we don't get to see a lot of you today, and we want to see you then for more of a social event. So more to come on that. General market update, things have been slower. We hear from everybody, all of our clients, that there's less IPOs, there's less transactions happening. That's a bit of the after effect of the last 2 years that were very, very busy. However, there remains lots of public companies out there that got created during the pandemic. And at least our view at the firm is that 2024 might still be a soft landing, but we tend to believe that it's going to be the roaring 20s. 2025 onwards, and let's hope there won't be a big crash in 2029, but history does tend to repeat itself. So our view is that a lot of industries will come back online by the 2024 well into that. So now is a good time to sort of relearn, refresh your knowledge about what's going on in the accounting, auditing, and regulatory world to get geared up for that. So we've got a host of speakers today. We have our partner Guy Thomas, who's going to give an IFRS and audit update. Reshma, Mahase, who's going to talk about the regulatory environment. Our partner Carmen, Newnham, who's going to talk about internal controls, which is becoming very, very important for public companies as well as accounting firms, because we also have to implement our own internal controls. So it's not just you, it's also us. Our partner Daniel Nathan will talk about group audits consideration. And then we're going to have a larger section this time about ESG, led by Mark Weston and Serenity Turner. You'll see a couple neat videos, and that's a big chapter that's about to start in a public company world in terms of disclosure and understanding, and so we thought it'd be important for you to start getting a good introduction into that. And then we'll wrap up with Bahar coming up and giving a bit of housekeeping update and give you some more information about what's coming up at Davidson & Company. Hope everybody's well. That you're having a decent year, and that we really look forward to seeing you on November 29th at our office for a drink and a bite. So our first speaker, Guy Thomas, who's going to tell you what's going on under IFRS, what's new, what's exciting, and what's happening in the auditing world. Guy?
Thanks, Erez, and welcome everyone. I'm going to be talking today about the new IFRSs and a little bit of a discussion as well on audit considerations. IFRS, or International Financial Reporting Standards, didn't move too much this year in the world of 23, but there are future IFRS changes that are going to be significant in your world. In particular with respect to ESG, which is environmental, social, and governance, and they will affect all publicly reporting enterprises. As well, the Canadian auditing standards, we refer to those as CASs, continue to evolve, and there is continuous vigorous regulatory oversight, which has now increased public disclosure of firms as well. So today we'll go through some of the IFRS changes, as well as some of the significant auditing changes that are going to affect your world. I've got a light theme today of Halloween. And moving along, we've got the first IFRS, and the only IFRS that's new this year is IFRS 17, insurance contracts. I'm not going to talk a lot about this because there's really not a lot that, of clients that we have in this sector. The intent, of course, is to provide more useful information. The impact is that it's going to create more volatility and a lot more disclosure. This is a new IFRS that's been a lot of years in the making, just finally came out this year. The main themes on this, there'll be a measurement of present value using an explicit risk adjustment. There'll be a contractual service margin used, and there'll be more effect through the P&L. Implementation by insurance companies subject to this standard required a lot of significant effort. And so now I'll move on to revisions of IFRS, revisions and amendments. The revisions I'll be talking about today are IS1 on presentation of financial statements, 8 on accounting policies and changes in estimates or errors, and IS12 on income taxes. So there's a few others, not going to go through those, but this is really 3 or 3.5 because income taxes get split into 2. Firstly, significant accounting policies won't exist anymore. They are going to be called material accounting policies. There's guidance on how the concept of materiality, both in size and nature, is used. But please note that financial statement disclosures in the notes don't change. This is just with respect to the accounting policies. The theme is material. Companies are required to disclose those, and I can see companies really perhaps changing the name from significant accounting policies to be material accounting policies. Others may do some revisions. IS8, there's a distinction here. This is accounting changes or estimates. There's a distinction between a change in accounting policy. It has a retrospective application both years, whereas changes in accounting estimates is a prospective application current year. There's a new definition. Estimates are monetary amounts in financial statements that are subject to measurement uncertainty. IS12 on income taxes, single transaction approach. This is more related to asset retirement obligations and leases, a single transaction where the tax asset and the tax liability will have to be recorded separately, can't be offset. It's pretty narrow scope on the initial recognition exemption. And the second part of the tax change is called Pillar 2, and it addresses some of the tax challenges in a digital world where there's application of a minimum tax of 15% in the country where revenues are generated. There's a temporary exemption. Right now it's disclosure for the potential effect. Pillar tax is not yet adopted in Canada, expected in 24. Again, pretty narrow scope. The only message here is there really is no escape from tax. Can't really see it, but I have a cleaver knife through my head there, and certainly there were a number of concerned children looking around on Halloween. On to amendments that are effective January 1 of 2024. IFRS 16 on lease liability and sale leaseback, 1 on liabilities current non-current, and 7 on cash flows for supplier finance arrangements. Again, these are quite narrow scope. For IFRS 16 on the lease liability and sale leaseback, variable payments that are not dependent on an index or rate are included in the measurement of the lease liability. So effectively there'll be a light increase in terms of the liability and the related asset. The general requirements will be applied through the rest of the term. IS1, liabilities is current and non-current. There's a right to defer. There's a question of right to defer settlement. Whether something where liabilities have an uncertain settlement date, there's guidance whether it should be classified as current. That is to say it's going to be applied within a year or potentially over the course of a longer term than 1 year being non-current. Effectively, you need to be compliant with the deferral conditions to apply. and it does include considerations for the breach of loan conditions or terms. IS 7, and this is one that's really more effective for companies that have third parties make payments on their behalf, or potentially factoring arrangements where or the company has to disclose the qualitative and quantitative information on any extended early payment terms, any guarantees, and other information. Yes, the steampunk era. So onward to a big one, sustainability standards, S1 and S2 it's referred to. These standards came out in June of this year, 2023. S1 is the general requirements for disclosure of sustainability-related financial information. S2 is climate-related disclosures. The effective date is January 1 of 2024, just around the corner, subject to adoption by local jurisdictions. Information here is to disclose material information about, there's a big term here, sustainability-related risks and opportunities. I refer to those as SRRO. I tried to put an acronym around that one because I don't want to say it every time. This change is going to be massive. And I'm going to, when I mention material, I'm just going to read out what material means. And that is that information is material if omitting, misstating, or obscuring that information could reasonably be expected to influence decisions that primary users of general purpose financial reports make on the basis of those reports, which include financial statements and sustainability-related financial disclosures which provide information about a specific reporting entity. Quite a mouthful. And there's also a concept here of dynamic materiality, because I think materiality will change over time. And what are the needs? Well, the needs are you're going to have an understanding of the scale of the reporting. It's not small. Identify and gather the relevant data. Establish disclosures. Need to enable users to understand the sustainability-related risks and opportunities, SRRO, and you need to start now. This needs to be a proactive process. It's not a reactive one. You've got to get started on this. It involves a new way of thinking. What are the corporate impacts that arise within the organization itself and throughout the value chain? And note that enterprises not only have risks here, there's opportunities. This is about what the enterprise uses and relies on to create, consume, and dispose of its products and its services. And where is it kind of coming from? Well, it's coming from the ISSB, which is the International Sustainability Standards Board, which now includes the Sustainability Accounting Board, so it's a subgroup now. It also comes from Europe, from Canada, from the US. There's GHG protocols, Scope 1, Scope 2, Scope 3. Scope 1 being direct emissions, Scope 2 being indirect emissions from purchased energy, and 3 is indirect in the value chain. In the short term, we expect to see disclosures in the Management Discussion and Analysis, or the MD&A, and I'm going to say that as auditors, we are required to review that information as part of our audits and look for misleading information. So there's going to be a lot of handover of information both from a company and from the auditor's perspective. Long term, I see these standards developing into financial statement disclosures. Right now, it's not financial statement disclosure level. There's 4 core elements to reporting: governance, strategy, risk management, and metrics and targets. These come from the 4 pillars of the Task Force on Climate-Related Financial Disclosures, otherwise known as the TCFD. And again, disclosure is for information that is considered to be material. I'm going to go through each one of these briefly. Firstly, governance. It's a description of the Board of Directors' oversight of SRRO as well as management's role in assessing and managing it. This is the who and the where, and it requires a level of expertise. Strategy. Potential impact on the existing business and its plans, and it's over various terms, short, medium, and long term. This is the how, this is the when, and it requires, again, expertise, and it requires knowledge of operations. Risk management, describing an entity's processes for identifying climate-related risks and risk management thereon. This is the where and the what. And lastly, metrics and targets. This is describing the metrics on how you measure the SRRO, the effect on risk management process, and greenhouse gas emissions, GHG, and targets. This is the what and the impact. We already know the why. IFRS says we have to deal with it, as well as user demand for increased disclosure on ESG. Location, where is this information going to be provided? Largely the MD&A, could be also in the Management Information Circular or in the AIF, the Annual Information Form. The timing of it, it's going to be concurrent with the release of the audited financial statements. There is no interim disclosure requirements, no comparative information in year one, and I think there is also a three-month extension for the first year. And please note this information is not going in your financial statements. Documentation. What do you have to document? Your government, just about everything. But let's start with governance meetings, your expertise and roles, strategies, resource allocations, risk assessments, and measurement criteria and the models being used. Oh, pardon me. And as auditors, we're going to need this information to assess the disclosures by the company to determine if it's consistent with our knowledge. So we'll be asking as auditors for more information to support the claims within the ESG disclosures. Additional resources on ESG, some good additional sources, Canadian Securities Administrators, a national instrument, as well as a CSA staff notice and audit firm guidance. There will be more to come today by way of presentations from both Serenity Turner and Mark Weston on ESG. But let's move away from ESG for the moment and see what's coming down the accounting pipeline. Yes, that's pretty sure that's Father Time way over on the left, and you recognize me, of course, on the right. So stuff coming at us, exposure drafts, projects underway, primary financial statements, disclosure initiative, management commentary, rate-regulated activities, and a bit on IFRS versus ASPE. So several projects, but there's really only one that I'm going to be focusing on, and that is the primary financial statements. This will have a huge impact on all companies because you're going to have defined totals in your income statement or your profit or loss statement. You're going to have operating income or loss, income from an integral associates and JVs, income from investing activities and from financing activities. Non-GAAP management performance measures will be reconciled in a note, and there'll be more disaggregation of information. For the non-GAAP measures, a company will also have to explain why that measure is considered useful. And if you want more information about the other projects, here are a couple of good links. You can look at this presentation later on. Don't worry about writing these down. And if you want additional information, a couple of good sources on the accounting side for sure is the IFRS Interpretations Committees, IFRIC, IFRS Discussion Group, IDG, CFA Staff Notice, CSA Staff Notices, and Audit Firm Guidance. Please note that the IFRIC is non-authoritative, but it is fairly lengthy in process, not necessarily as timely as some people would like it due to the review process behind it. The IFRS discussion group, the IDG, is non-authoritative but more timely. I think they meet 3 times a year, and sometimes you need to read between the lines to determine the outcome, but very useful. CSA staff notice is great for continuous disclosure considerations, and audit firms obviously non-authoritative. And Reshma Mahase will be providing a regulatory update a little later today as part of today's presentation. That is it for the IFRS side, but I think we need to discuss some audit considerations. So companies need to know what they are or what they need to prepare for. Don't be afraid. So there will be a continued focus here on Canadian standards on quality management. That's within the firm. That's not something that companies deal with. It's a firm requirement referred to as CSQM. Estimates will still be a big item. Assessment of risks, communicating deficiencies of internal control, group financial statements, as well as key audit matters. The CSQM, just briefly, is basically a firm performing internal controls on itself, internal control testing. It's what we do for an internal control for our own processes, which includes remediation, which is then subject to regulatory oversight. The CAS 315 and 265 largely relate to an assessment of internal controls to define risk, has been and will continue to be a significant area. Group audits, if you have consolidated statements, you have a group. And CAMs, those are customized to a company's assessed risk and mitigation. Briefly on CSQM, again, just for audit firms, this is a firm system of quality management. So we don't just perform quality audits, we have a quality firm throughout. This is a requirement under Canadian auditing standards. It's a risk-based approach, really, of our operating system. There's formal processes here, there's committees, there's internal monitoring, and quality control reviews. As I said earlier, it's kind of internal to the firm. It's required for all firms. It's a big shift. It required big resources. CAS 540 on estimates. A lot of things we need to do. Understand management's processes, perform a retrospective review, determine if you need specialized skills, assess for error or misstatement, determine an audit approach, test the estimate itself, look for indicators of bias, and then stand back and evaluate at a high level. Anytime you have significant judgments or estimates, you can expect that it'll be challenged. And the key is to be prepared, and if available, please provide third-party information. Prepare a position paper that includes a background, the issue, the relevant guidance, the application of that guidance, and a conclusion. And when we test estimates, which we have to do in most audits, we need to determine if that method is correct, the data is accurate, the assumptions are supportable under audit. We can also look to subsequent events, or the use of our own internal auditor estimate, which often involves the use of our evaluation team. As auditors, we perform walkthroughs of the controls around significant estimates, and don't underestimate the amount of time that it takes to assess and detail procedures. If there's any big judgments, get them to us early. Ensure these are well documented and well supported. Do the research, provide the backup. Examples of estimates, just very quickly, convertible debt, business acquisitions, asset retirement obligations. So in terms of focus for the upcoming year, we expect there are changes to our estimates because of changes of inflation, interest rates, climate-related issues, could be supply chain issues, could be flood, could be fire, and changes in share price, which may affect impairment considerations. They would affect, we expect, asset retirement obligations, impairment of long-lived assets, collection of receivables, fair value measures, provisions, and estimates based on cash flows. We encourage CFOs to consider all of the above. We then encourage audit committees to ask management and the CFO of their documentation of the assessments and the impacts. Okay, moving along for further audit considerations. CAS 315, this is a risk assessment. The emphasis is on internal controls. We evaluate them. We don't necessarily rely on them. To get us through this, we need an understanding of the entity. We assess the likelihood and magnitude of potential misstatements. We do a stand-back assessment. And where there are significant deficiencies in internal controls, we are required to communicate those to the audit committee. Documentation of the design and performance of the control procedures by the company is required. We have a saying in our firm, if it's not documented, it's not done. So this year you can expect more questions on internal controls and related to ESG. Such as the fire, flood, supply chain issues, environmental impacts. And Carmen Newnham will be elaborating more on internal controls and deficiencies in a short while. So an auditor is required to gain an understanding of control that address significant risks, journal entries, test the operating effectiveness, the design of the audit procedures, look at general IT controls, look at the process for making estimates, and that is a requirement, and test the design and implementation of those controls. They may affect our audit plan. They may affect our communication in the audit report with respect to the key audit matters. And a company's focus should be to update and maintain the internal controls, the documentation thereon. And this is about all of the areas we've just discussed, as well as ESG. Document, document, document. Much of this information should be supplied, actually all of it should be supplied in the early stages of the audit. Again, it affects our risk assessments and our audit plan. And the controls will be tested for implementation, and there's a potential for those significant deficiencies that, again, we have to communicate to the audit committee. Moving on to CAS 600 on group audits. It's really, these changes are a little bit more in terms of the audit work, clarifies involvement in planning, as well as the direction and supervision. Some of the perhaps bigger changes, enhance acceptance and continuance requirements. Management will be now required to acknowledge access to information and unrestricted access to personnel, and it articulates two-way communication throughout the audit. The changes have come around as a result of just continued complexity, both in terms of management, IT, emerging market activity. These items will more formally become part of the client acceptance process, as it is part of CSQM. And the new CASs will necessitate, of course, more documentation. And Daniel Nathan will speak to this more in the presentation. CAS 701, briefly, significant risks and how we mitigate them. That's in your audit report. Hint to the CFOs, look to last year's audit report for the CAMs and look to this year's communication to the audit committee for identification of significant risks. For each significant risk, ensure those controls are in place, that you have procedures and you have approvals, and they are documented. New sustainability standards for 2024. Key here is to get started. Increased education is required. It's already November of 2023. We have association rules that require us to review the information to make sure it's consistent with our knowledge obtained during the audit. The company information and disclosure will need to be provided early in the 2024 audit. That means provide an MD&A closer to the beginning of the audit when you send financial statements, because they should both be going out at the same time. A lot of companies are still in the education stage, but need quickly to move into the execution stage. So those are the considerations for the IFRS changes and considerations from the audit perspective. At this time, I would like to say, well, thank you, as well as introduce Reshma Mahase, an assurance partner extraordinaire with a whole bunch of initials behind her name, who will next be presenting on the audit regulatory update.
Thank you, Guy, and thank you everyone for your time today. My name is Reshma Mahase, an audit partner at Davidson. We thought we'd add this session or this segment to today's session really to give you an update on audit regulatory matters and why it's relevant to clients and companies. Over the years, the regulatory framework and landscape has changed. It's become significant, with public accounting firms in Canada being regulated by the Canadian Public Accountability Board, or CPAB, also by PCAOB to the extent they're registered, while also working in consort with the various Securities Commission. The extent of regulations have enhanced and increased over the years, with more findings or deficiencies, as they refer to, really being triggered by new standards, new technologies, and new tools being implemented. To date, we've seen the rigor from the Canadian Public Accountability Board, being CPAB, increasing their regulatory hurdles and rather overcoming some of their regulatory hurdles by putting more disclosures onto firms. We've seen that more recently in January 2023, where CPAB enhanced their disclosure requirements, now allowing them to publish and censor certain firms as a result of their regulatory inspections. CPAB is also looking to extend and enhance their disclosure requirements. Why does it matter to you? Well, now they're requiring that audit committees get communicated to at an individual file level. We're also seeing that potentially that each firm's inspection reports will now be published on CPAB's website. These changes will better align with what the PCAOB currently does, and in some cases with what the CSA and other regulatory bodies, being the Securities Commissions, already require. These changes are coming also at a time where, as Guy mentioned, firms are required to implement CSQM. CSQM required firms to implement, test, and report on its suite of controls. These suite of controls not only govern the firm, but it also governs the firm's risk and its risk assessment processes. In October 23, CPAB has already published in their interim report that certain firms are facing challenges with meeting this timeline and requiring additional resources to complete their initial evaluation by the required date. That required date is December 15, 2023. As mentioned, inspection findings and deficiencies are part of a landscape internationally, where both CPAB and PCAOB, to name a few, report all their inspection findings to the international bodies. As you can see on this slide, inspection findings are continuing to decline year on year, with 2022 over 2021. That being said, themes continue to be consistent. Again, in October 23, CPAB has published the initial themes around internal controls and risk assessment, which Carmen will get into in a bit. Also the use of service organization reports, and more specifically, management's controls, so the controls that the company has in place over these activities or processes governed under service organization reports. They also talk about inventory and the use of perpetual inventory systems. And lastly, back to auditors' documentation, supervision, and review. So why does it matter? Well, audit quality matters to everyone, to everyone being its stakeholders, to auditors, regulators, users being the investors, management, and more importantly, those charged with governance, being the audit committee. As you can see with audit quality, this transition period really is putting a paradigm in terms of the landscape And what's happening, we're seeing new requirements coming from not just the regulators, but standards. Standards shifting for new industries and new tools. We talked about new tools, but now there are new technologies. So clients are using new technologies to really enhance their operations. And what that means, auditors are now using different tools and techniques to be able to audit in this environment. And now new risks are coming out as a result of this. And I think where Carmen will discuss a bit further on around internal controls and risk assessment, this continues to be a focus of the regulatory bodies around the firm's risk assessment of the company. And lastly, in this space, we're seeing the macroeconomic environment. Right now, the macroeconomic environment is really weighing heavily in the amounts being reported, not just in estimates, but in disclosures as well. So we're seeing enhanced disclosures and enhanced reporting around key estimates such as valuations as it relates to impairment and acquisitions. As part of audit quality matters, firms have been charged with meeting and expanding its regulatory resources. We've had significant push around staff retention and staff recruitment. We've also talked about CSQM and the implementation of the suite of standards to really be able to manage this changing landscape. And then lastly, we've developed new tools and techniques on auditing, not just to manage the client's expectations, but to also meet the records and align with the records that management is keeping. With that being said, we've included a bunch of links here. Again, not to take notes on it, these links would be available on the slide deck. And we've isolated a couple around CPAB, PCAOB, and the Securities Commission. One thing of note, the Security Commission, being the CSA and the BCSC, they've also published disclosure deficiencies recently. And there is some overlap over what we're seeing with CPAB and the PCAOB, where the Securities Commission are talking about financial statements not being compliant with IFRS, as an example. They're also talking about misleading claims around sustainability, where Mark and Serenity will be talking a bit more about it. They're also talking about requiring companies to really look at the estimates that's being made and the assumptions being made based on macroeconomic factors. For example, COVID, looking at those assumptions and the adjustments to those assumptions. And also urging companies to really look at their non-GAAP measures and whether those assumptions should also be adjusted. These findings together being CPAB, PCAOB, and the Securities Commissions do require additional resources to ensure measures are in place to address these areas. And as a result, firms have been charged with a significant amount of cost in meeting this. I'll now pass you over to Carmen, who will talk about internal controls. Thank you so much for your time.
Good afternoon, everyone. A topic that is consistent through all audits is your auditor must gain an understanding of the company being audited. Guy introduced some of the requirements under CAS 315. Identifying and assessing the risk of material misstatement, on how your auditor goes about doing this. I will go into a bit more detail here, as the standard did change last year, and some of you may have noticed some additional communication in your audit committee letter around internal controls. This picture nicely depicts a company's control environment. We start with the risk assessment process. This means the company's process for identifying the business risk relevant to financial reporting. Next is the process for monitoring. How does the company monitor that? Next, we have information systems and controls, meaning the system the company is using and how information flows through those systems. And lastly, the control activities. At the start of our audit, we generally send the understanding of the entity memo and the understanding of internal environment. This helps us lay the foundation for what controls the company has in place. But the next step is very key, and that's the walkthroughs we actually do to gain a better understanding of those internal controls. Walkthroughs are time consuming, just probably like you find completing those memos we give you. but they're very important for us to be able to identify what controls the company has in place and if the company has appropriately made those controls to assess the risks that they have. Next, we have some common examples of the controls that we're going to look at. Journal entries, this is required to look at for all audits. Significant risk areas, a cheat for this is to look at your audit committee communication letter that we send out at the beginning of an audit. This lays out what the auditor has identified as your significant risks, and will generally have a discussion of these areas at the planning stage. The next is purchases and payables, receipts and receivables, and payroll. Here's an example, impairment of E&E assets. This diagram is probably too small for you to actually see, but I'll run you through it. At the top, we have processes, narration, risk control, and walkthroughs. I'll go through each at the same time, not to waste any time. So, under narration, this is what the company has told us of their process that they have in place. The first thing they've mentioned is the company holds weekly exploration calls to discuss exploration results and potential issues of the ongoing programs. These are attended by senior management in both Mexico and Canada. This is followed up by a financial call to discuss the finances to support the exploration plans they have in place. What's the risk here that they're addressing? Property is not being reviewed regularly for impairment. Next, the control. Documented weekly calls they're having. The walkthrough, the engagement team will obtain and review these meeting minutes. It's important here now to make sure that you have someone who's very detail-oriented to take notes at those meetings. We want to see exactly what you talked about and what the potential problems the company is foreseeing in the future. The next point that management has laid out is that they have management led by the CEO prepares a monthly report that includes detailed project comments. These are discussed at the quarterly board meetings. So again, here we're talking about the same risk and control. But what is your auditor going to look at? They're going to again ask for those meeting minutes as well as probably a sample of the monthly package that the CFO is preparing. Finally, the last point that they've narrowed out here is that a third-party consultant and land manager helps the company by ensuring that their claims are in good standing and prepares a package for them to show when payments are due. What will your auditor look at here? The auditor is going to want to see the contract in place with that third party, as well as a claim listing of the claims that the company has associated with the property. Your auditor will do sample testing to verify that those claims are in good standing. So this example shows no internal control deficiencies. But let's be realistic. Not all companies have the perfect process in place. Lots of times when we speak to clients, they'll say, yes, we do these things, however, it's not documented. So what's your auditor going to say? If it's not documented, it's not done. That's the key phrase here. So make sure that you have some proof to show what the company is doing internally. We need something tangible to see and review. Now the final step. If you do have some deficiencies, how are those going to be communicated to you? The requirement under CAS 260, communicating those charged with governments, is that the auditor should communicate significant deficiencies in internal controls. This differs from PCAOB, which requires all deficiencies to be communicated. What is a significant deficiency, you may be wondering? Well, there's a lot of judgment that goes into this, but some common things that identify to the auditor it may be significant are misstatements detected in the audit process, restatements for corrections of material misstatement due to fraud or error, evidence of management's inability to oversee the preparation of financial statements, evidence of an ineffective entity risk assessment, multiple deficiencies in a single business process, and finally, lacking position papers for complex transactions. Let's go through an example of what it will look like and how it will be communicated. Here's a snippet from our audit committee letter. You'll see the subtopic being evaluation of internal controls. If there are significant deficiencies that need to be communicated, we'll be adding a table. This table will outline the deficiency and the potential effects, as well as will provide a recommendation of what the company can put in place to address these deficiencies. Another important fact to note here is we don't want to be telling the company what to do. So we're also looking for you to tell us how you're going to solve this problem and what you're going to implement that we can potentially test in the future. So that's it from me, but what should you take away from this presentation? If it's not documented, it's not done. Remember, that's the key phrase you want to be remembering. So next up, we have Daniel Nathan, an audit partner who will be discussing group audits.
Thank you, Carmen. My name is Daniel Nathan. I am an audit partner here with Davidson & Company. The topic I will be discussing is one that I deal with every day, which is the audit of groups. Groups can refer to an audit involving multiple subsidiaries, branches, business lines, or other types of components of an operation. In recent years, we have seen group audits become a key focus of regulators, with new standards slated to become effective in the next 2 years in both Canada and the United States. We believe this increased focus could have an impact on our clients with respect to the audit process applicable to the various components of their businesses. The new standard becoming effective in Canada is actually a revision to an existing standard called Canadian Auditing Standard, or CAS 600. Today, I will review the nature, timing, and objectives of the revisions, the communication requirements, and some key takeaways for you, our clients. The revised CAS 600 is effective for periods beginning on or after December 15, 2023, with early adoption permitted. So if your company has a December year-end, the revised standards will be effective for your 2024 fiscal year. CAS 600 provides guidance on auditing group financial statements. In most circumstances, this will be most impactful in the audit of a business with foreign subsidiaries, which may require us as the lead or group auditor to engage a component auditor in the local market. Component auditors may complete a full audit of a component entity and report to us, or they can perform specific procedures over material balances, such as performing inventory counts, which we rely on to issue our consolidated audit opinion. In full audits, we are part of the audit plan and review process. For specific procedures, we are directing those audit tests and procedures to be performed on our behalf. CAS 600 provides guidance for all of these situations, and more broadly to all organizations meeting the definition of a group. The revisions to CAS 600 include new requirements and application material which better aligns with other recently revised auditing standards, some of which we've touched on here today. The new requirements also increase the auditor's responsibilities related to professional skepticism, planning, performing, documenting, and communicating throughout the audit. The ultimate objectives of the revised standard include encouraging proactive management of quality at the component and group level, keeping the audit standard fit for a purpose of a wide range of circumstances in a developing environment, reinforcing the need for robust communication and interaction, and fostering an appropriately independent and challenging skeptical mindset of the auditor. The revisions cover all the key areas of the standard. I will highlight a few of the most impactful. First, scope and applicability. The new standard clarifies the terms consolidation and flexibility. Consolidation for purpose of this standard does not necessarily mean what is commonly understood in industry. The process is now defined more broadly as potentially scoping in traditional consolidation, proportionate consolidation, equity method accounting, and aggregation of financial information of business units, branches, and divisions. Flexibility requires us to look beyond legal structure when planning and performing a group audit in a way which takes into account different and increasingly complex group structures and information systems. As such, the concepts of components are now wider than previously defined. Finally, the standard encourages its application even to non-group audits where it may be applicable, such as engaging another firm to perform an inventory count of a non-group audit. Next is quality. The new standard explicitly requires the application of the audit standard on quality, which is CAS 220, to be applied to group audits as well. Areas such as sufficient and appropriate resources, nature and timing, and direction of component auditors are the lead audit firm's responsibility. Risk-based approach is the next area. Similar to quality, the new standard explicitly requires us to apply the requirements of the new standard revisions to CAS 315 regarding risk assessments. It now stipulates the lead auditor's role and responsibility to assess risk at the group level and provide direction to component auditors in designing and performing procedures. Continuing through the revisions, materiality. The revised standard clarifies how the concept of materiality and aggregation risk apply in a group audit. Communication and interaction with component auditors. The new standard further outlines the group auditor's interaction requirements with component auditors, including determining and communicating competence and capabilities of the component auditor and the relevant ethical requirements. It also outlines specific required matters to be communicated by the component auditor back to us, the group auditor. Lastly, restrictions to information and people. The new standard clarifies the various types of restrictions a group auditor may face in applying the revised standard, including access to component management, those charged with governance of the component, information at the component level, and the component auditor's audit documentation. It now provides guidance on how to overcome these restrictions, particularly at the outset of the audit, by requiring the group auditor to obtain agreement to access from group management. With all of the increased requirements being placed on audit firms, we believe it is important to communicate with you, our clients, early where they may feel the potential impacts of these changes. With the expanded definition of group audits, it is possible that more of our audits will fall under the requirements of the revised standard. When they do, we are expecting to have increased direct involvement and access in component operations. What does this mean? For you, it means that corporate level management should push component managers to prepare and communicate their financial reporting earlier. Make sure it's clear and understandable, and ensure it is in line with the group reporting policies. Finally, we expect to have more in-depth discussions with management and audit committees about operations at the component level as these revisions take effect. With ever-increasing rules, I thought I'd leave on a bright note for our client, which is that we believe we have anticipated the majority of the changes with respect to our approach for component audits in recent years. Our hope is that by engaging with stakeholders and anticipating the regulatory climate, we can minimize the impact felt by the increasingly explicit requirements. We hope that as a result of our approach and the new group audit requirements, financial statement users can feel assured that consistent quality standards are being maintained across the audits of entire organizations. So thank you very much, and I'll now pass it to Mark Weston to talk about sustainability. Thank you.
Thanks, Danny. That's interesting stuff, technical stuff. Actually, I get the pleasure now of talking about some things that are actually quite easy to comprehend, big picture, that is. We're also going to introduce some videos that were produced by Davidson's sustainability and ESG reporting practice. And hopefully those will put things in context, get you to step back a bit and really understand the big picture, because sustainability really is about the big picture. First thing, let's talk about words, sustainability and ESG. Stepping back, sustainability is really just a way of doing business. A way of doing business that considers stakeholders, that considers risks, that considers the manner by which risks are mitigated. ESG is simply a way of measuring management's efforts towards sustainability. Actually, right now we're going to play the first of our 3 videos called Let's Talk Sustainability. See you in a couple minutes.
Mark, what is sustainability?
Well, Bahar, sustainability is really about using resources, both natural resources and human resources, in a way that meets the needs of the present without compromising the ability of future generations to meet their own needs. Sustainability involves considering environmental, social, and economic factors to ensure a balanced and responsible approach to development and resource use. Sustainability applies to companies of all sizes. Companies need to be able to operate profitably in the present while ensuring that they'll have access to the market, raw materials, human capital, and social license they require to operate profitably in the future. Sustainable business practices are those that minimize negative environmental impacts, promote social equity, and create long-term value for the company's stakeholders.
Sustainability has been in the news a lot, but it seems to have quieted down. What's going on there?
Well, that's a great observation. The first thing to realize, though, is that things are occurring at an incredibly quick pace. Companies are talking less about sustainability and instead implementing the sustainability plans developed over the past few years. They're talking less about what they intend on doing and more about what they've actually achieved, particularly around emissions reductions, responsible use of natural resources, diversity, equity, and inclusion, and governance.
So what are the main takeaways here?
I think the main takeaway, Bahar, is that sustainability is becoming understood and accepted by companies and embedded in the way they do business. The sustainability plans I see explain what the company's sustainability commitments are, why they chose them, and the progress they're making in attaining them. The plans consider sourcing of natural resources, securing of supply chains, and the mitigation of key risks relating to recurring natural events. The plans also detail how the company is going about building a diverse, equitable, and inclusive workforce and ensuring that an effective governance structure and accountable leadership is in place. Sustainable business practice. It's quickly becoming imperative and in many ways just makes good business sense. All right, good stuff. Well, hopefully that put things in context a little bit. Sustainability, once again, just a way of doing business. What about ESG now? A lot of perception is that ESG disclosures are sort of fluffy in nature and don't really have an impact. In fact, ESG, sustainability reporting, has been around for probably 10 or 15 years, and why are we just hearing about it now? Well, the perception is wrong. ESG and those specific pillars of ESG, environmental metrics, sustainability, social metrics, and governance, really can have a giant impact on a company's business, both in the short term, the midterm, and the long term. As a chartered business valuator, I really think about a couple things: risk and reward. If you decrease the risk, you increase value. On the other hand, a failure to mitigate risks increases the risk, which decreases value. Our next video is called Let's Talk ESG. Hopefully that'll put a couple things in context.
Tell me about ESG. What does it stand for?
ESG stands for environmental, social, and governance. The E relates to the environmental metric. The E relates to the company's overall impact on the environment and the potential risks and opportunities it faces because of environmental issues. It considers factors such as carbon emissions, air and water pollution, waste management, loss of biodiversity, and the sourcing and usage of water or other natural resources.
The S in ESG is the social component. This evaluates a company's relationship with its employees, customers, suppliers, and communities it operates in. It includes aspects such as workforce diversity, employee turnover, labor practices, product safety, community engagement, and its overall social responsibility.
G is for governance. Governance involves managing the company's values, beliefs, and principles, managing risks and impacts across environmental, economic, and social dimensions, and overseeing the relationship between management, the board, and the company's shareholders and stakeholders. Governance should create structure and process. Good governance is consensus-oriented, accountable, transparent, and inclusive.
So then what is ESG reporting? Are companies actually doing it?
Think big picture. This is about informing stakeholders with what you're doing about sustainability and giving them the information they need to make informed decisions.
Stakeholders aren't only shareholders. They're future investors, regulators, and customers, as well as employees, suppliers, communities, or Indigenous peoples. Stakeholders' decisions might be whether to invest in or lend money to you, buy your product or service, or personally associate with or champion your brand, supply raw materials to you, permit access to resources on their land, or in the case of communities, to grant you the social license to operate.
Stakeholders want more than just generic statements. They're increasingly demanding to know what the company's sustainable goals are, how they intend to attain those goals, what is the process of achieving the goals, and how the process is governed.
Companies are already starting to communicate sustainability initiatives and results in MD&As or annual information forms, as well as in standalone or in some cases fully integrated reports. We're also seeing sustainability being communicated in news releases with increasing scrutiny from securities regulators. In the future, more and more companies will be disclosing information such as what sustainability means to them, what they've done to reduce their carbon footprint and minimize the impact of the use of their products, relevant metrics relating to their ESG initiatives, and how they're ensuring that sustainability commitments remain a key priority throughout the company. There's never been a better time to start thinking about ESG. So now I have the pleasure actually of introducing Serenity Turner, who's going to talk a little bit about the financial reporting and processes that relate to ESG. But remember, sustainability, it's just a way of doing business. ESG is a way of measuring sustainability efforts. Sustainability, there's never a better time to start thinking about it.
Thank you, Mark. Good afternoon, everyone. My name is Serenity Turner, and I'm here to discuss financial reporting and processes relating to ESG. As previously noted by Guy, the IFRS released sustainability standards S1 and S2 earlier this year. Their effective date is January 1st, 2024. Currently in Canada, adoption would be voluntary. It's not mandatory, and it will not be mandatory until it's been enforced by regulators. So how likely is it to be mandated in Canada? Currently, it's been endorsed by the International Organization of Securities Commissions, the IOSCO, in June of 2023. They will be monitoring the adoption of ESG assurance standards by its members in 2024 and future years. The IOSCO regulates more than 95% of the world's securities markets in more than 130 jurisdictions. In Canada, securities commissions that are members include Alberta, British Columbia, Ontario, and Quebec. And the IOSCO has called upon its members to adopt, apply, or otherwise be informed by the ISSB standards. Other Canadian events that support the adoption of the standards S1 and S2 were the announcement made by the Canadian Securities Administrator in July of 2023. They've announced that they will collaborate with the Canadian Sustainability Standards Board, the CSSB, to adopt S1 and S2. They have noted that they will modify standards as necessary for Canadian markets. For example, although S1 and S2 recommend the use of the SASB standards to develop industry-specific metrics, the CSA has noted that these will likely need to be adapted for the Canadian market to address specific risks and opportunities that are relevant to us. The CSSB recently released the results of their consultation with Canadian stakeholders. Key findings were that there is strong support for the uptake or the implementation of the ISSB standards within Canada, but there also have been requests for interpretive guidance and examples to address issues around implementation. They've noted that reporting should be principles-based and consider interactions with existing frameworks and standards. They should also consider whether disclosures that will be required are important to society and the environment, whether they operate well with our existing frameworks, whether they're consistent with advances in the regulatory space, and whether they can be audited. Finally, of particular importance to Canadians is safeguarding of Indigenous rights as a human rights subtopic in disclosures required by public companies. For those of you who are considering adopting S1 and S2, there are transition reliefs that are specific to those standards. For example, in the first year, only climate-related risks and opportunities will be required for disclosure. However, in the second year, companies will also have to adopt sustainability-related risks and opportunities. Likewise, in the first year, companies would only have to adopt Scope 1 or Scope 2 greenhouse gas emissions, but in the second year, they would have to disclose Scope 3 greenhouse gas emissions. Similarly, for comparative information, in year 2, if you've disclosed climate-related disclosures, you would have to provide comparative information, whereas by year 3, you would have to provide comparative information for all disclosures that are included in your report. Finally, in terms of the release date of the report, companies would have until the half-year mark to release their sustainability report. So this would likely be aligned with a company's 2025 Q2 financial statements. But in the following years, their sustainability report would have to be released concurrently with their annual financial statements. And to note, there will likely be transition relief specific to the Canadian market that will be covered by the securities administrator. Then finally, within Canada, as already stated, the adoption of S1 and S2 will not become mandatory until the Securities Commissions release official guidance. So oversight and guidance is going to come via the CSA as well as the Provincial Securities Commissions. Currently, there is draft guidance available in the form of National Instrument 51-107, Disclosure of Climate-Related Matters. The NI 51-107 is very closely aligned with the requirements of S1 and S2. The exposure draft was published in October 2021, and the 4-month consultation period has since closed with the receipt of 131 submissions. Key comments included overwhelming support for aligning Canadian securities law climate-related disclosure requirements with the Task Force on Climate-Related Financial Disclosure Guidelines. Additionally, 57% support the requirement to disclose climate-related governance and risk management regardless of materiality. 79% support mandatory disclosure of Scope 1 emissions for all issuers, and 68% support mandatory disclosure of Scope 2 emissions. Currently, the proposed effective date is passed, and the CSA has not released any further information as to when we can expect its implementation. Therefore, it's unlikely that it will become effective this year. Key takeaways for National Instrument 51-107 is that it will apply to all reporting issuers. It's composed of 2 key forms, 51-107A, which includes the disclosures specific to governance, and Form 51-107B, which includes disclosure requirements specific to strategy, risk management, metrics and targets, which includes greenhouse gas emissions. These disclosures are required to be included in one of the following forms in descending priority. So first, in a company's management information circular. If they don't release one of these, then in the annual information form, and finally in the annual MD&A. Issuers will have to determine where they plan to include these disclosures and plan accordingly. The expected effective date, once the national instrument is officially passed by the CSA, for venture issuers, reporting would begin in the financial year beginning on or after January 1st of the first year after adoption. Non-venture issuers would have an additional 2 years before they would have to adopt the disclosure requirements of NI 51-107. As previously stated, these key disclosures include governance, strategy, risk management, metrics and targets, and greenhouse gas emissions. Next, we will take a detailed look at what it means to apply the requirements of NI 51-107. To start with governance, what are the key takeaways? 1, how does the Board of Directors oversee climate-related risks and opportunities, or CRROs? And 2, what is management's role in assessing and managing CRROs? So what does this mean from a practical perspective? It means the board should be asking themselves the following questions. Who on the board is tasked with overseeing CRROs? Do they have a formal committee dedicated to this task? Does that committee or members have any special qualifications, for example, education or relevant experience that makes them appropriate to assess CRROs? What are the board's policies around this? How often do they meet to discuss these policies? How are metrics determined and how are targets tracked? Who is responsible for this? Similarly, for management, senior management would need to determine who is responsible for the oversight of CRROs and what are their qualifications to do this. What controls or procedures do they have in place to manage the oversight of CRROs? And finally, who do they report to and how often do they report? Looking ahead, companies, as they're beginning to implement this, should consider leveraging their existing processes. All companies already have controls in place, and some of those controls will be similar to what needs to be put into place for sustainability reporting. Boards and senior management should also consider obtaining qualifications. And finally, and most importantly, everyone should make sure that disclosures are supportable, that they're backed up with evidence, and that they can be audited. In order to aid in our understanding, we're going to complete a case study of Yamana Gold Inc. Yamana Gold is a large Canadian mining corporation that owns and operates gold, silver, and copper mines in Canada, Chile, Brazil, and Argentina. They were acquired by Pan American Silver in March of 2023, and they have been publishing a climate action report for the last several years, which is prepared in accordance with TCFD guidelines. This is the closest example that we could get to a report that would be prepared under National Instrument 51-107, as the requirements are more or less consistent. So in this example, Yamana Gold is disclosing what their existing governance structure looks like and how they've tasked it to assess climate-related risk and opportunities. Additional disclosure that is provided in the report would be detailed descriptions of each group's responsibility. For example, the executive chairman and the board ultimately oversee our progress against Yamana's climate-related targets and goals, and along with the Sustainability Committee, receive monthly environmental performance reports. Then, to move on to strategy, key takeaways from the National Instrument are providing a description of the identified short, medium, and long-term CRROs. In addition to identifying the CRROs, a company must describe the impact on the business, overall strategy, and financial planning. So what does this mean for a company? In terms of identifying risk, companies are going to need to think outside of the box. They're going to need to extend the time frame that they would normally consider, avoid the tendency to only think of near-term impacts, which is kind of consistent with how a company prepares their financial statements, because they tend to look backwards. Another key takeaway is that companies need to be specific in their description of how a risk will impact the company and avoid using boilerplate language. Finally, remember that under the proposed national instrument, this disclosure is only required if it's material to a user. The specific definition of materiality used under the national instrument is that something is material if a reasonable investor's decision whether or not to buy, sell, or hold securities of the issuer is likely to be influenced or changed if the information in question was omitted or misstated. On this slide, we're sharing an assessment model for climate-related risks, opportunities, and financial impact that's been taken from the TCFD recommendations. This model is a great starting point for companies to look at when they're trying to understand how they're going to develop their in-house risk assessment and assessment of opportunities. So if we look at this slide, some examples that we could think of that would be relevant to a Canadian mining company in terms of transition risk are the implementation of carbon taxes in Canada. This could result in higher underlying costs for fuel and natural gas, which could impact a company's bottom line. An example of an acute physical risk would be loss of access to exploration sites due to forest fires or floods. This could drive impairment of underlying assets. And finally, an opportunity for Canadian companies would be to build and promote positive relationships with Indigenous groups. This could promote access to natural resources and bolsters reputation with stakeholders. If you refer to the TCFD recommendations, there is a detailed list of risk examples and opportunities that is a great starting point for any company looking to jumpstart the risk identification process. To return to our case study, Yamana Gold has disclosed both risk and opportunities in their climate action report. As we can see here, they've broken their risks into short-term, medium-term, and long-term risks, and then shown how it progresses over time. Definition of timeframes is required under IFRS 1, S1, and S2. As we can see here, not all these risks are necessarily applicable to Canadian companies, but some key risks that could be applicable include the impact on insurance premiums, fire threat, flooding, and carbon pricing. In addition to identifying risks, companies must also assess their impact. Potential impacts on a company's future strategy based on these risks could be to prioritize opportunities to access cost-effective renewable energy, to promote the use of recycled water rather than new water, and to develop a comprehensive water management plan. In addition to the risks disclosed, Yamana Gold has also disclosed the potential opportunities that they see with respect to climate change. And again, while not all opportunities may be present in Canada, some certainly are. As previously noted, renewable energy, while a risk for companies, is also an opportunity. Canada is a world leader in renewable energy, generating almost 2/3 of its electricity from renewables such as hydro. So for any Canadian company, there's definitely opportunity in Canada to implement a plan now to start transitioning your energy sources over to renewable sources. Another opportunity for Canadian companies is looking at financing opportunities. Increasingly, investors and financial institutions view companies with a defined sustainability plan as more attractive. For example, the Royal Bank of Canada has committed to providing $500 billion in sustainable finance by 2025. The takeaway from this is that companies are going to have to evaluate the range of CRROs and the impact on a case-by-case business, considering factors specific to their company, to their industry, and to their location. To move on to risk management, the key takeaways here are describing the process for identifying, assessing, and managing CRROs. Additionally, a company will have to describe how they've integrated those processes into their overall risk management structure. So what does this mean for a company? If we take a closer look at IFRS S2, some of the questions that would be asked of a company to describe their risk management process include things such as what inputs and parameters are used by the company. Does that include the use of climate-related scenario analysis? How does a company assess the nature, likelihood, and magnitude of the identified risks? Do they only think about quantitative factors, or is there a consideration of qualitative factors as well? Whether and how the entity prioritizes climate-related risks, and how the entity monitors climate-related risks. To return to our case study, Yamana Gold has provided detailed disclosure around how they're answering these questions. If we look at this example, we can see that they are describing how their process is organized. For example, Risks are assessed by various buckets and at different levels. In this case, they assess risk at both the site level, regional, and national level. They've also identified that multiple teams are responsible for this risk management process, including the use of external experts if required. They've described how they manage risks. They seek to understand the significance of a given risk and what the consequences could be, and then evaluate how likely that is to impact them. And finally, they demonstrate that the consideration of CRROs has been integrated into their overall risk management process via upwards communication to senior management and the board of directors. Right. The next set of disclosures required by National Instrument 51-107 is that of metrics and targets. Companies must disclose both the metrics that they use to assess CRROs and the targets that are used to manage CRROs. With respect to metrics, companies need to look at this from both a company-specific position as well as an industry-specific or even country-specific position when they're considering what metrics will be useful for them to report. Some examples from IFRS S2 include the percentage of assets that are vulnerable to climate-related risks or aligned with climate-related opportunities, the amount of CapEx that they have deployed against climate-related risks and opportunities, or the percentage of key management compensation that is tied to goals linked to CRROs. With respect to targets, companies must consider both quantitative and qualitative targets. They need to disclose what the objective of these targets is, how they define the parameters that allowed them to set the objectives. They should detail how the targets are aligned with the metrics, as well as with an organization's overall strategic goals. And finally, they should disclose any milestones that have been developed and the company's performance towards achieving these milestones. Again, for this section, disclosure is only required if material to users. So companies will have to make an assessment of what would be material to their stakeholders. In this slide, we're showing an excerpt from the SASB standards specific for metals and mining. The SASB standards are promoted by S1 and S2, which require companies to look to these standards for industry-specific guidance. The National Instrument does not require that at this time, but it can still be a very helpful place for a company to look at to help determine metrics that might be appropriate for your company's operations. In this example, they've noted that some potential metrics that could be useful for a mining company would be tracking greenhouse gas emissions, monitoring air quality, looking at energy management, or looking at water management. As we can see in our case study for Yamana Gold, they've tracked three of the things that we just looked at, three of the metrics that we just looked at in the SASB standards. They're tracking their greenhouse gas emissions. At the date of the release of this report, they're still only disclosing their Scope 1 and Scope 2 emissions. But for future evaluation, they do plan to put a plan in place to measure and disclose their Scope 3 emissions as well. In terms of transition risks, they're tracking the amount of renewable electricity as a percentage of total electricity consumption. And finally, for physical risks, they're looking at water usage after recycling on a year or intensity basis. And finally, the last key disclosure that's required by National Instrument 51-107 is that of greenhouse gas emissions. Key takeaways are that Scope 1, Scope 2, and Scope 3 emissions and the related risks should be disclosed. If a company chooses not to make these disclosures, they will be required to explain why. And then finally, companies must disclose the reporting standard that they use to measure greenhouse gas emissions. Most people are using the greenhouse gas protocol. This is not required under the National Instrument, but if you're not using the greenhouse gas protocol, then you must disclose or explain why the standard you're using is comparable and why it's appropriate to use. To break down Scope 1, Scope 2, and Scope 3 in a little bit more detail, Scope 1 encompasses direct greenhouse gas emissions by a company. An example of this from a mining perspective would be emissions from mining equipment or vehicles that are used on site. Scope 2 is a type of indirect greenhouse gas emission, And an example of this would be emissions that were generated by whoever makes your energy. So if you're buying electricity and they're producing emissions, this should be included in your Scope 2 disclosures. And then Scope 3 is also indirect, but it's much broader, and it's tracking emissions that occur in the value chain. That can be downstream or upstream. An example of this would be emissions that result from the processing of ore by one of the company's customers. So if you sell ore to someone and they release emissions, that should be included within your Scope 3 emissions disclosures. The Greenhouse Gas Protocol, which is the recommended standard to track these, is considered to be the gold standard of emissions reporting. Its use is required by S1 and S2 and recommended by the National Instrument. The calculations can be very complex, as you can imagine when you think about the breadth of disclosure that would be required under Scope 3 emissions. Companies will likely need to engage a specialist to help them prepare these reports due to the significant judgments and estimates that are contained within. And finally, significant planning is going to be required by a company to implement the adoption of the Greenhouse Gas Protocol. Now is the time to start. This is an excerpt taken from the Greenhouse Gas Protocol that describes the common steps that would be taken to identify and calculate greenhouse gas emissions. Robust controls will need to be created by a company to ensure adequate separation of duties and to ensure that these steps are being tracked and documented by the company and that an appropriate or comprehensive paper trail is being left. Implementation will be very time-consuming and will require detailed analysis and planning. Having appropriate documentation around this is key. And then to return to our case study, this slide contains the greenhouse gas disclosures made by Yamana Gold. Currently, they're only disclosing Scope 1 and 2, which are grouped into this report rather than being separately identified. And then Scope 3 will come at a future date. In this case, Yamana has chosen to disclose their emissions by specific project because they have projects located internationally. Each company is going to need to consider how best, for their stakeholders, they will have to provide these disclosures. There's no prescribed way to show it. It's more about what's useful to your stakeholders and what's the most logical way to break it down. So companies need to start thinking about this now, what they want to disclose, how they're going to do it, and how they will support it. So in summary, the key areas of focus for climate-related risk and opportunities, disclosures required under the National Instrument, include those of governance, strategy, risk management, metrics and targets, and greenhouse gas emissions. If we were to compare the National Instrument to IFRS S1 and S2 at a high level, the core disclosures are essentially the same. Both of them are aligned with the requirements of the TCFD, the primary difference being that under the National Instrument, users will not have to disclose their climate resilience, which is basically how prepared or how strong the company is, how ready they are to face the challenges that might arise under certain types of climate risk. Both the National Instrument, S1 and S2, well, I shouldn't say both. S1 and S2 requires the use of SASB standards as well as the Greenhouse Gas Protocol. Currently, the National Instrument doesn't require it, but it is recommended. Finally, adoption is still voluntary in Canada at this stage, and the disclosure format will likely be similar whether you're reporting under S1 or S2 or under the National Instrument. Currently, there are some existing reporting requirements in Canada with respect to climate-related disclosures. There's 3 CSA publications, Staff Notice 51-333, 51-354, and 51-358. The main takeaway of the staff notices is A, only material information needs to be disclosed at present. The information that companies should be disclosing currently are their environmental policies, which are fundamental to operations, board of director oversight and management of environmental risks, if material, describe how this oversight occurs and who it's been delegated to, and include environmental goals or targets, if material. 51-534 builds on this in the sense that it expanded the risk disclosure to include climate change related risk in addition to just environmental risk. And finally, 51-538 was updated to clarify that a company's approach to materiality may need to be expanded to assess climate change related risk. They're going to need to expand their assessments beyond a short-term time horizon, and if practical, they should quantify and disclose the potential financial and other impacts of identified risks. The 5 key required disclosures under the existing staff notices are those around environmental risks, trends and uncertainties relating to these risks, environmental liabilities, asset retirement obligations, and then the impact and environmental protection requirements. To compare the proposed national instrument with the existing requirements, currently, only disclosures of governance and risk management, if material, are required. Under the national instrument, it would be governance, strategy, risk management, metrics and targets, and greenhouse gas emissions. So disclosures that are coming will be much more rigorous and comprehensive. Under existing requirements, there's no need to align with the TCFD, SASB standards, or the Greenhouse Gas Protocol. And finally, the disclosure format would likely be similar, regardless if you're reporting under existing requirements or under the proposed national instrument. To look at this from an assurance perspective, currently, there's no regulatory requirement to obtain limited or reasonable assurance around the disclosure of climate-related disclosures. However, we do need to consider the implications of CAS 720, which is the auditor's responsibilities relating to other information. Auditors are still required to review information contained in the annual information form or the MD&A for consistency with the financial statements. And this process will be happening with respect to current disclosures required under the staff notices or upcoming disclosures under the national instrument. And finally, increasingly, companies are increasingly providing voluntary disclosures, to bolster their reputation with stakeholders or at the ask of other stakeholders such as investors or creditors. So auditors, whether it's under CAS 720 or a more rigorous assurance approach, are going to be asking a lot of questions, and we'll be asking for supporting documents to support this climate-related disclosures that are included. Other currently existing applicable standards include CSAE 3410, Insurance Engagements on Greenhouse Gas Statements. To give you an idea of how long this has been around, this standard went into effect in September of 2013. It covers both limited and reasonable assurance engagements, and its purpose is to detail assurance requirements to substantiate greenhouse gas emissions reports. There's also a draft CSSA 5000, General Requirements for Sustainability Assurance Engagements. The exposure draft for this was released in September 2023, and the comment period closes by December 31st, 2023. And it will only apply to attestation engagements with respect to sustainability reporting. The key takeaway from this is that standard setters are creating assurance standards with the expectation that in future, auditors will be required to review or audit these disclosures. And they're preparing us so that we can come to you with the appropriate questions. So looking ahead, this is a list of questions that companies should be asking themselves. These auditors are either directly or indirectly going to be asking these questions. Companies' best practice is to begin planning how to answer these questions now. Who's going to be responsible? How are you going to put the necessary controls in place? And how are you going to evidence that those controls are actually operating as designed? Preparing to answer these questions cannot be done at the last minute. This will likely require a cross-functional team, depending on the size of your company, to be created, and is going to impact many different areas of your company, from your operations managers to senior management and those in charge of governance. Tone at the top is going to be crucial to implementing these changes. The COSO framework recently released a guide to implementing effective internal controls over sustainability reporting. On this slide is an expert talking about 3 attributes of ESG reporting that are significantly different from financial reporting. One of those is the termination of organizational boundaries. Under IFRS, this is pretty straightforward. Either you consolidate a company or you don't. For sustainability reporting, this can become a little bit more murky, and a company is going to have to put processes and controls in place to understand and document how they are making these determinations, because it's going to impact their reporting. From a sustainability reporting perspective, disclosures are often highly qualitative or narrative in nature. So we're going back into the world of estimates and judgments. And finally, their disclosures tend to be forward-looking rather than historical-looking like financial statements. So all of these are going to require that a company implement specific controls around sustainability reporting that likely will be somewhat different from the existing controls that are in place. And these controls should be designed so that they result in an audit trail. So the COSO framework is a great starting reference point for companies that are seeking to understand the types of controls that should be put in place to ensure accurate and complete reporting. And then finally, if we think about interaction with existing IFRS standards, some of the standards currently affect that could be impacted by climate-related disclosures or risks and opportunities, IFRS 9 financial instruments, property, plant, and equipment, intangible assets. There could be valuation or impairment issues related to climate risk. Inventories. Could inventories' net realizable value decrease if new legislation was placed? That decreased demand for a company's products. Companies will also have to consider the impact on provisions, contingent liabilities, or contingent assets, in as much as they're driven by or impacted by climate-related risks and opportunities. And finally, fair value measurement can directly be impacted by these because they're often going to be incorporated into a discounted cash flow model. Mark Weston will return shortly to discuss the implications of ESG on valuations. In summary, consideration of the impacts of sustainability factors is already a requirement for financial reporting and continuous disclosure. Requirements are only going to become more rigorous over time as regulators adopt S1 and S2, and by extension, the national instrument. Companies need to start preparing to report on sustainability factors now. Some resources that can help companies with this process are the COSO framework, achieving effective internal control over sustainability reporting, recommendations of the Task Force on Climate-Related Financial Disclosures, and reviewing the Greenhouse Gas Protocol, a corporate accounting and reporting standard. Thank you all very much, and Mark Weston is coming back.
Thank you, Serenity, for that extremely detailed and quite comprehensive discussion. Let's move from the detailed to the bigger picture again, and that's sustainabilities and valuation. Before we even go into this, so let's think about, once again, value and risk. Any of the sustainability or ESG factors that we've talked about, any of those that impact risk will have an impact on value. That's the thing to think about here. So we're not talking about disclosure yet, we're just talking about impact on value. If we consider impact, probably the one I'd like to focus on the most is asking ourselves, does the company's business model face threats from climate change and regulation? Does the business model face threats from climate change? So let's just look at that. Climate change could be things like, how about supply chain? How about where you're sourcing your natural resources? How about emissions and how that might impact the company's ability to do business? These are all things that would have an impact on the company's cash flows, therefore also impacting the company's value. Have to keep that into mind. ESG framework, as we talked about before, is just a way of assessing management's sustainability efforts. It provides a structure to identify, quantify potential future risks and opportunities through explicit forecast adjustments or scenario analysis. The exercise really starts with management's forecasts. So once again, management needs to identify, consider, and quantify the ESG considerations that are inherent in the forecast. Revenue. To what extent have we considered the impact of supply chain on revenue and on costs? To what extent have we considered shortages with respect to raw materials on cost of sales and the ability to fulfill revenue assumptions and revenue forecasts? Management needs to be able to consider the specific areas where ESG factors have impacted revenues, cost of sales, and expenses. Not only that, but they need to be able to support those to the auditors. Direct valuation implications could be in areas such as asset impairment. That's where we're going to see a lot of it, really, because any type of goodwill impairment or even purchase price allocations, any valuation of an intangible asset, such as goodwill or other intangible assets, start with a cash flow forecast. The question will be, to what extent has management reflected the risks associated with climate-related matters in those forecasts? Second question is, to what extent has management supported those risks or those assumptions? Very, very key. Other areas would be the useful life of assets. How will those be impacted? The fair value of the assets, fair value of onerous contracts. How would a market participant consider the impacts of climate-related changes on those cash flow forecasts? Specific valuation considerations would involve the use of the market approach. Once again, when we're looking at market data, we have to ask ourselves simply this: to what extent have sustainability and ESG factors been considered by market participants? To what extent are they reflected in the market data that we're seeing, the valuation multiples, etc.? Eventually, we're going to have to be calibrating market inputs such as EBITDA multiples to the extent that they reflect ESG factors. It's going to be a very, very complex process, but once again, just stepping back, let's just start with the forecast and really understand to what extent have risk and uncertainty relating to climate-related disclosures or climate-related matters been reflected in the cash flow forecasts. In conclusion, what we have is many ESG factors will have an impact on value. Many of these are also going to be incorporated into management's forecasts. At the end of the day, these risks can't simply be adjusted vis-a-vis a valuation adjustment. They're going to be reflected in management's forecasts. So to management, I would ask to clearly identify the stakeholders, clearly identify the risks, clearly identify and be able to articulate how we're going to address those risks. In that case, everything should be quite comprehensive and it'd be a nice package to support to the auditors at the end of the day as well. ESG risks and opportunities can't be dealt with, once again, by a simple valuation adjustment. We're going to conclude with a video, the third in a series called Let's Talk Opportunity, and it's going to really talk about the opportunities presented by identifying and mitigating risks.
Mark, should companies, particularly small and mid-sized ones, be concerned about sustainability and ESG?
Absolutely, Bahar. There's increasing evidence of the linkage between ESG and value creation. I'm a chartered business valuator, so let's consider the impact of risk on a company's value. Regardless of political or ideological views, companies that understand sustainability and have a sustainability plan of some form in place will be in a better position to mitigate environmental and social risks and navigate the regulatory challenges that are almost certain to present themselves. Everything else being equal, decreasing risk increases value.
So how would a company start its sustainability journey?
Well, Bahar, the first step is to obtain an understanding of what's important to the company's stakeholders. Next, identify 2 to 3 strategic sustainability priorities in areas in which you can make a meaningful change. The next step is to create a sustainability mission statement and communicate the company's vision to stakeholders. After that, develop a sustainability strategy that includes targets and goals and assigns accountability for sustainability targets. To promote a successful sustainability strategy, It's crucial that every employee understand how sustainability affects the company and their specific role. It's not as daunting as it may sound, and there are tools available to guide the company through the process.
Mark, perhaps we can speak more about sustainability plans in future episodes, but for now, what are the main takeaways?
The main takeaway, Bahar, is that at some point, almost every company is going to be scrutinized by somebody. Having an understanding of sustainability and having a detailed sustainability plan in place is quickly becoming expected and just makes good business sense.
Thanks, Mark. And thanks to everyone for tuning in. The link to your survey, slides, PD certificate, and recording will all be emailed to you in the next day or two. Erez, upcoming events?
Yeah, so as mentioned at the beginning, we've got a client appreciation party November 29th, 4 to 8 p.m. Watch out for the invite. Call us or email us at events@davidson-co.com in case we don't get you. And then upcoming events too, January 17th, 2024 is when we do our annual regular update where we bring in representatives from CPAB and the commission. So stay tuned for that. Sign up for that on our website as well. Thanks a lot, everybody, for keep on supporting our firm today and into the future. We really, really appreciate it.
Awesome.
And that's it.
Follow us on LinkedIn for the latest and greatest.
Okay. Bye, everybody.